What is up, guys, and welcome back to the Blockware Intelligence YouTube channel. My name is Blake Davis, and we're back for episode 4 of Crypto Equity Investing 101. This episode is going to be extremely important, and it's one of my favorite concepts to talk about, and that is risk management. As always, keep in mind that none of the information in this series is investment advice. I'm not a certified financial advisor, and nobody should pursue any investment strategy without conducting proper due diligence. So, what is risk management? Well, it's exactly as it sounds, it's managing risk. So, as traders, we use a quantitative method for protecting your account from downside risk. Another important vocab word is going to be risk tolerance, which will be how much risk you're willing to take on. And risk tolerance is unique to you. It's dependent on a lot of factors. One of them could be age, right? If you're close to retirement, you're probably not willing to be risking as much money per trade as someone who's maybe 20. There's also your time preference. So if you're a low time preference individual, that would mean you discount the future less than someone who's high time preference, which would mean that you value the future more so than someone who's high time preference. So if you are actively thinking about the future and preparing for the future, it's possible that you'd want to take on less risk than someone who really values the present. Also, if you have a lot of liabilities, so if you have to make interest payments or you have kids in college or whatever, chances are you're not willing to be risking as much as someone who has, very little liabilities. There's also the size of your account. So if you run a small account, you could probably afford to take a little bit more risk versus someone who's running a very large account and doesn't want to risk as much capital per trade. I've also included here a quote from one of my favorite books called Reminiscences of a Stock Operator, which says, always sell what shows you a loss and keep what shows you a profit. And now that's kind of going to be the backbone of risk management. It's going to be cutting losses and selling what shows us a loss. So now we can kind of get into the meat and potatoes of risk management. And the place we're going to start is with the stop loss order. So a stop loss is a type of order that sells your shares at a predetermined price that is below the current market price level. So that's going to, give you a predetermined loss that allows us to quantify risk. And the stop loss is going to be your best friend, right? Because every big loss was always once a small loss. So if we decide to cut our losses short, then we're protecting our account from large drawdowns and allowing ourselves to make a lot of small losing trades that are going to be vastly outweighed by the larger winners. But there's also this kind of give and take with the stop loss where we need to balance giving our stocks room to run because sometimes, your stock might need a little bit of room. If you're using too tight of a stop, then you're probably going to get stopped out much more than you should. And, a lot of times that stock is going to turn around on you and leave you behind. So we need to give our stocks, a little bit of room, but also we don't want to take on too much risk. So if we're using too wide of a stop, taking too large of a loss, then it's going to be much harder to outsize those losses with gains. So a good generic rule for your stop loss is 7%, and that's the number that was come up with by Will O'Neill, who's the CanSlim How to Make Money in Stocks investor. And he's one of the greatest investors of all time, an absolute legend who spent decades researching the market, and he came up with 7%, not randomly. What he found is that statistically speaking, using a 7% stop loss is a good number where you're giving your stock enough room, but chances are if it's breaking down below 7%, your timing's off or the market's no good. Another common stop loss rule is used by Jim Ropel, and he uses a 3-5-7 stop loss. So you sell 1/3 of your position when you're down 3%, you sell the next third when you're down 5%, and you sell your last third when you're down 7%. So in this method, you're still giving your stock room to run, but you're progressively exiting the position as it's working against you. So by the time you get to that 7%, you're only down to a 1/3 position, and you average out to only a 5% loss on the stock. We can also use a technical level, so looking at the chart, finding a spot where if price broke down below that level, it would be a clear sign that this trade isn't working for you, and we could look to re-enter in the future. And this is my personal favorite. It's what I use the most. It makes the most sense to me, but it also requires a bit of experience. So that's why I included that. Just strict 7% stop loss is an amazing place to start. And taking a loss on position right? It sucks. Nobody wants to take a loss, but you absolutely have to listen to your stop loss. And that's kind of part of building discipline as a trader is eventually you're going to start to realize that if you ignore your stop, most of the time you're going to end up really hurting yourself. So the sooner that you can come to terms with my stop loss is in cement, it's final. I absolutely have to listen to my stop loss, then the sooner that you're going to be able to, start to make some outsized gains. A couple analogies that I like for the stop loss is I've heard, would you fly a fighter jet without a parachute or would you drive your car without insurance? So the stop loss is like the parachute for your account, right? You can't take a big loss if you have something to protect you. So something that also has to do with the stop loss is what we'd call a batting average. So that would be, what percentage of your trades are profitable versus how many times are you stopped out. And the reality of the matter is that the majority of your trades are going to be losers. If you're very good, maybe 6 out of 10 trades are losers, 7 out of 10 trades are losers. But for most people, it's 8, 9 times out of 10, it's going to be a stopped out position. And if that's true, so how are we going to make money? Well, it's exactly what I just talked about. If you're taking a lot of small losses, then the times that you're going to make 30, 60, 100% on a position, then that's when you're going to make back all those losses and more. And that's what's really going to, help build your account and grow your capital. So now let's look at an example trade using Coinbase from October of 2021. So here you can see this is October 15th, 2021, and this is the day that I probably would have been buying coin based off this chart here. So, if you remember what we talked about last week, we talked about support and resistance. So you can see on this day, we're starting to break above that resistance. You haven't quite fully cleared it yet, but I like to cheat sometimes, get in a little bit early. So this is the day I would have been looking to buy. You can see we had broken through the 50-day moving average, which is this red one here. The prior day, you had broken this downtrend line as well. The green 8 or 10 EMA, excuse me, is now above the 21 EMA. And volume's picking up. You have all these fairly bullish signs. So this would have been a place I would be looking to take a stab at buying some coin. So I would have been looking to buy through resistance at this 280.61 level, which is this horizontal line, which is the high a day from this previous high. So I probably would have placed my stop loss right at about low of day. So this is a technical level that I like to use for my stop losses, the lowest price point of that day. If it had broken below it, that would have been a big signal to me that, hey, coin isn't ready yet. Maybe the market's not good. There's a variety of reasons, but if it had broken through the low of day, I would have been looking to get out. So I would have placed my stop loss at that low of day at 266.53, which would have given me about 5% risk on this trade. So you can see this was a winning trade, and you would have made roughly 17% at about 5% risk. And this day here is probably where I'd be looking to get out of it. So I'll talk more about sell signals in the future. I'm a little bit more short-term swing trading. It's different for everyone, but what I'm looking at is the character of the stock. Right? Stocks are like people; they all have different character. And this trend here with coin was that it was tracking above and riding this 10 EMA in green higher. So the moment that it's starting to break down below that 10 EMA, you can see this big downside reversal bar. That would have been a signal to me to be looking to exit this trade. And I generally don't like to sell everything at once. And it's hard to say in hindsight. I wasn't trading coin in this move, so it's hard to say exactly where I would have exited this position. It's easy to say. Obviously, I would have waited and sold the rest of it here, but for the most part, I would be looking to get out of it this day. You see it breaks the 10 EMA, gets down almost to the 21 EMA, which it hadn't done since before the breakout. So this is another example of a trade using Riot, the Bitcoin miner. So this day we would have been another fairly strong buy signal for me. You could see this. It's kind of hard to see there, but the 10 EMA is creeping up over the 21. You're kind of bouncing up off of it. This upside reversal candle, which is through this resistance level, which was tested here, once, twice, 3 times, and the more times a support or resistance level is tested, the more significant it is. So the fact that this was tested 3 times, then finally breaking out to the upside again, here it failed. This has been a day that I would be looking to buy. It's also breaking through this downtrend line here. So I would be looking to buy roughly at around $58, which is, somewhere in here. And if you wanted to use a low of day stop on this particular trade, it would have been about a 9% loss, which for me is much too big. So let's say instead you wanted to use that 357 rule I told you, where you're selling, 1/3 at 3%, 1/3 at 5%, last third at 7%. You're averaging out to a 5% risk on this trade. So now you can see if this had been your trade, you would have bought here. And, this Riot has still not recovered from that level. So if you were not using a stop loss and had that mentality of, I'm right, the market's wrong, you would still be waiting for Riot to return to those levels. So using a stop loss is great and all, but it doesn't matter if you're taking small losses if you're using a massive portion of your account on each buy. So we combine position sizing, the size of our buys, with the stop loss to finally quantify exactly how much we're risking. So position sizing, we're looking at as a percentage of our account, how much are we risking on each trade. So an average position size, which I think is a good place to start, would be a 10% position using a 7% stop loss. So with that, you're only risking 70 basis points or 0.7% of your account. Position sizing is definitely something that people really struggle with at first, right? Everyone wants a big gain. In order to make a big gain, you had to have a lot of your account in one position, right? Well, that's not necessarily true. Having multiple winning positions a year with small losses and also managing risk correctly, you're able to make a lot of money. So your position sizing is super important. It's something that you really need to get down early. I think 10% is roughly a good place to start, but it's dependent on a lot of factors. So I think the number one factor for the size of your position should be the health of the market. So if the market is not healthy, like it is today, we're in a bear market. You wouldn't want to be piling into new positions with, a large portion of your account. So right now we're in a bear market. I would be looking for, right now I'm not looking to make super strong buys, but you test the waters with really tiny positions, and then once you kind of get some traction, then you can start to build up those positions even larger. It's also dependent on your account size. So people with really large accounts tend to take on smaller positions. And if you have a smaller account, you can get away with doing a larger position. But like I said, it's all dependent on market health. Just because you have a small account doesn't mean you should be taking a 20, 30, 50% position with every trade. It's also about experience. So if you're really new to the market, I would highly, highly, highly recommend starting off with really small position sizes, maybe 5% of your account, because chances are, you don't have that experience. You don't have the expertise to know, when things are looking great, when things, may appear great on the surface, but, deep down, really aren't awesome. So having experience allows you to get away with larger position sizing, but it's definitely something that you need to practice and a skill you need to acquire as you gain experience in the markets. And most of the time, we don't want to dive into our full position size right off the bat. So, one way we can go about building out a position is through pyramiding. So, pyramiding is building your position in several buys. And what this does is it allows you to risk less of your capital early in the trade when it's more risky, and then to feed your winners, as I discussed earlier with that quote from Reminiscences of a Stock Operator: always sell what shows you loss and feed or keep what shows you a profit. So by risking less earlier in the trade, and then maybe you get stopped out, you're risking even less of your account versus piling in right away. And another thing is one quote I really like is, plan your trade and trade your plan. So before you even make the buy in the stock, write down mentally in the notes app on your phone on a piece of paper exactly as large of a position as you would like, where you're going to make your buys, where your stop losses are going to be, so that when things go awry, which they often do in the market, you already have a plan. You know exactly what you're going to do. Another quote from Reminiscences is this story about two friends chatting in a bucket shop, and they're saying The man was so nervous that a friend asked what was the matter. I can't sleep, answered the nervous one. Why not? Asked the friend. He said, I'm carrying so much cotton that I can't sleep thinking about it. It's wearing me out. What can I do? Sell down to the sleeping point, answered the friend. Sell down to the sleeping point is a super famous quote. A lot of people who have, done their homework on the markets would know this quote, and that's basically talking about position sizing, right? If you're so overweight in one stock or one area of the market that you're worried sick, you can't sleep thinking about it, then chances are you're way over positioned in that stock. So position sizing is really important for keeping your account alive and also for the mental aspect of trading. Another important concept that has to do with risk management is selling into strength. So like I said, we always want to keep our winners, but usually it's the right call to take some profits. So the William O'Neill rule is to sell 50% of your position when you're at a 20% gain. And once again, this isn't some random number that he made up through years of studying the markets. He determined that after roughly a 20% gain on a breakout, stocks are generally due for a consolidation or to rebase. And selling into strength isn't easy, right? Everyone wants to be a winner. People get greedy in the markets. Everyone's guilty of it. I certainly get greedy more often than I should. But selling into strength can be hard when you're in a winning position. And what I found is that generally at the point where I'm starting to get excited about my position and I want to, tell my friends, look how much I'm making in the stock, that's like the moment when it's going to turn around. So selling into strength is always super important and really helps to manage risk, take risk off the table, and protect your gains. So this is, a method of actively managing the risk of a winning position. So it's not all or nothing in the market. You can take some off the table and you can take some gains. It doesn't mean sell your entire position if you're at a 20% or a 30% whatever gain. It just means maybe take some off the table, take some chips off the table. And what this does is it removes the possibility of a full-blown round trip. So what we call a round trip is in the stock market, you make a buy, you're up 20%, and then that thing just, rainbows, and you go right back to break even, and you turn a winner into a loser. And this is one of the worst things, and it's definitely was a struggle of mine in the beginning. So by selling into strength, you're eliminating the possibility of a full-blown round trip. Another important rule I think that should be discussed is what we call the 8-week hold rule. So what this says is if you make 20% is roughly a good spot to start taking some profits. But if you make that 20% in 2 or 3 weeks, chances are you could be in something that's very special. So you want to hold that stock for 8 weeks and not take profits unless it breaks some of our sell rules. So last week I talked about the 50-day moving average being your guardrail. So even if something had passed the 8-week hold rule, you'd made 20% in a week and you're saying, hey, now I'm going to hold this for 8 weeks like the rule says. But if it breaks, a key moving average like the 50-day, the 8-week hold rule is out the window and you need to get out of that stock. So now I'm going to walk you through a full trade using Silvergate Capital in September and October of 2021. So this was a roughly 4-month consolidation period here. This is what we might call a wedge, or a volatility contraction pattern, a VCP. But basically, it kept running into resistance around this 24 level. So support and resistance levels aren't necessarily final in that it can be a range. It doesn't have to be one specific number that gets tested over and over again. It can be a range, a few dollar range. So like I've highlighted here in gray, this would be a resistance range. So on this day here, you can see with my mouse, this was probably the day that I would be looking to buy Silvergate, as it's breaking above this previous resistance range that had been tested 3 times over the course of many months. When we're breaking above it, and you can see, this volume, rising up into this resistance break. So this would have been the spot that I was looking to buy Silvergate. So if you wanted to pyramid it into your position, let's say you did it over 2 buys. So you could buy 5% when it broke this 124 level, which would have been right around in here at these highs. and you would have had 5% of your account in it then. And then for a pyramid, generally it's a percentage gain. So once you're up X percent, you decide that that's when I should have a full position. So common ones are 2-3%. Just for this example, I'm just using 1%, but you can do it a lot of different ways. So 1% gain, this share price would have been 125.24. So that's when I would have wanted to add my next 5% to build a full 10% position at an average price of 124.62. So you would use a stop loss on that first buy because if the position goes against you, you're not going to make your second buy. You're only risking that 5%. So let's say you want to use a 7% stop loss on that initial buy. Your stop loss would have been at 115.32, which is somewhere around here, and you'd only be risking 0.35% of your account on this trade. Now, SI was a huge winner at the time, and if you wanted to, sell half of that position at 20%, you would have had that order in at 149.54, and then from there, I would move my stop loss up to break even. So I don't want to, if I'm up 20% in this position, I don't want to leave my stop loss at a 7% loss, right? I'm going to bump it up. So for this example, I'm going to bump that stop loss up to break even or my average share price. And this would have been a stock that would have passed that 8-week hold rule. So if you had decided that you're not selling it for 8 weeks, this day up here would have been the first day that you would have been looking to potentially sell the stock. That would have been 8 weeks. But if you didn't want to use the 8-week hold rule, I probably would have sold the the last half of my position here on this day. So like I showed you guys with the Coinbase example, stocks have character. SI had a similar character in that it was riding above this green 10 EMA. So on this day, this was an earnings gap down. This is when I would have been looking to get out of my last half of the position, which that last half would have been up 10.5%, and the first half you sold at 20%, so you made a 15.25% gain on this trade. Now, I tend to try to lower my position sizing into earnings. I think holding a full position or a big position into an earnings call is gambling. Most of the time, you're not right. Even if you've done all your due diligence, you're so confident they had a strong quarter. The reality is you don't know. So I always like to take some chips off the table when I'm going into earnings. But either way, if you'd held it, we gapped down pretty sizable here, and you broke that 21 EMA. Now, what ended up happening was, that was the, near-term low. So, I'm always looking to, potentially re-enter a stock once I've completed my trade. So, you could see that, the reality is that SI wasn't done on this run. Maybe you were a little bit off on your selling. You still made a 15% total gain. You didn't know what was going to happen, right? So you can never beat yourself up for selling and managing risk. It's the analogy that I've heard is you don't get mad at yourself because you bought car insurance and you didn't get in an accident that year, right? You don't know, so you always have to protect yourself. You can't be mad about taking a loss or not selling at the perfect time. So here on SI, I probably would have been looking to re-enter right around here. I then probably would have exited this trade here on this day. Once again, it's breaking a pretty key moving average that it had for the most part been holding for quite some time. So this is likely the day I would have gotten out. Also, definitely would have sold here. This is a pretty large bearish engulfing candle. But yeah, that's all I've got for you guys. I hope you guys enjoyed the video. I appreciate you guys all watching, sticking around to the end. If you liked it, feel free to subscribe to the channel, leave a like, leave a comment with some feedback. My Twitter DMs are open. So yeah, thank you.